Dan, looking like your call to see a tactical downgrade of Chinese equities, that is looking vindicated given the country is at a later stage of the recovery. Is there further to go for this downturn in Chinese stocks? Where do you hide?
Well, I think that emerging Asia in general, not just China, is going to be going through a bit of a soft patch. We've had a bit of a soft patch over the past month or so. The problem, obviously, is what's going on in the U.S. with U.S. bond yields backing up, real rates going up. That isn't good for emerging markets in general. And then on top of that, you've got the problems in China where this is a country at an advanced stage of its economic recovery, and it's time for the authorities to tighten up on their support measures a bit, which has problems for Chinese shares. But there are places to hide. I think one good place at the moment is Japan. We just made a tactical upgrade of Japan. Japan tends to do well when the dollar is strong, when interest rates are rising, when real rates are buoyant, and we've got all those conditions in place now. So Japan is worth a look on a tactical short-term basis.
Now, returning to China, the CSI 300 below 5,000, about 80% of stocks on the index losing momentum. Tech shares getting hammered. Will valuations then look healthier after the sell-off?
Yeah, they will. And I wouldn't say that they're extremely stretched. They are looking more expensive than peer markets in the region, and that's one of the reasons why we have been favoring other markets within Asia-Pacific region over the past month or so. But I think that on a longer-term basis, China still looks good. There's still a lot of good companies. And when interest rates peak in the U.S., when the dollar peaks out, which we think will happen in the second half of the year, then I think people will turn back to China along with other emerging markets in Asia.
Now, you also trimmed your overweight on Korea. How are you factoring this global chip shortage in plays like Korea as well as Taiwan?
Well, clearly this favors both of those markets. And we remain positive, particularly on memory stocks, which is one of the reasons why we still have an overweight in Korea. The trim that we made in Korea is more tactical, short-term, surrounding the events in the U.S. with the stronger dollar and the rise in real rates. But we think that we will probably put money back into Korea once trends in U.S. financial markets turn more favorable in the second half of the year.
Now, Credit Suisse is bullish on the U.S. recovery, anticipating a V-shaped rebound potentially. Who would then be the biggest winners in Asia? Which sectors would be the biggest beneficiaries?
Well, I think as far as sectors are concerned, auto exporters are the main winners. In theory, technology stocks also gain because the U.S. market is critical for technology exports. But technology is inherently less cyclical than autos. Technology held up pretty well last year, whereas auto sales in the U.S. suffered quite a bit from the pandemic, and that means that they're going to have a much bigger bounce. So auto exporters are the main places we would be looking from a sector perspective. I think one place worth looking at from a market perspective that is somewhat overlooked would be Singapore. Singapore has very high export exposure to the U.S. It's an export-oriented economy. The market tends to do well when U.S. interest rates are rising, and it's a place that people aren't heavily weighted in at present. So that would be a bit of a contrarian pick for us.
Now, what's the outlook for Philippine equities? It's seeing some steep losses, the world's second worst share market year to date. You had a session with the BSP governor earlier this week. He's saying that there still is more room to support the economy. How's this framing your view on Philippine stocks?
I think it's too early to be going into the Philippines right now because of the pandemic. They are struggling to gain control over the domestic caseload. That's going to keep consumption and the economy depressed for longer than in, say, some other markets in the region. On a longer term view, though, I think that the Philippines will become a place that people turn to again. Number one, the valuations have gotten cheap. This has historically been an expensive market, but now it's starting to look cheap. And secondly, it's got good structural growth. This is a lower income economy with a lot of headroom before it reaches middle income trap issues. It's got strong demographics, a great consumption story. So eventually, this will be a place to go to, just a little bit too early right now.
Now, Dan, just returning once more to greater China markets as we see the downturn continue this Thursday, how much more downside do you see for the benchmarks, the CSI 300, the Shanghai Composite, as well as the Hang Seng?
I see fairly limited downside. I don't see a quick recovery because of these headwinds that we've been discussing. But I think that the medium-term story for China and emerging Asia in general is still quite strong. You still got a lot of good companies. You still got good earnings growth. You have good structural growth. You've got a financial system which is being opened up to global investors. So eventually, these structural strengths will place a floor on how far things can fall. But 2Q will be challenging.